Okay. Ladies and gentlemen, Assalamu alaikum and good morning. It is my pleasure to speak today at this 13th International Conference on Mobile Commerce in Pakistan. First, I would like to thank Total Communications for organizing this important conference. I hope that this conference will provide an excellent opportunity to the participants to share their knowledge and expertise. I also need to state a disclaimer at the start that whatever I say in this talk are my personal thoughts and do not necessarily reflect SBP policy stance. Technology these days is impacting each and every aspect of human life, including, of course, financial services. One of the way it is doing so is through the adoption of artificial intelligence and data sciences. And here I am taking the liberty of including machine learning and robotics as part of AI for ease of discussion. The AI related opportunities across the financial services continue to thrive amid considerable hype around the technology. AI is going to impact not only the financial statements of the banks, but also their operating structures and thereby bring efficiency while also enhancing the quality of controls. Based on an estimate, the aggregate cost savings for banks from AI applications is estimated around $447 billion by 2023, with the front and middle office accounting for $416 billion of that total. Majority of the large international banks are already implementing AI strategies and have deployed many innovative solutions by doing this. Banks can leverage AI on the front end to smooth customer identification and authentication, thereby deepening customer relationships and providing personalized insights and recommendations. In developed countries, a significant majority of the people don't prefer using brick and mortar banks for anything. The clients' customer support expectations have not really changed in terms of what they expect, but how they expect them has significantly evolved. AI has clearly impacted this landscape with AI-enabled chatbots and voice assistants, which have started to become a norm at major international financial institutions. The biometrics like facial and voice recognition are getting increasingly smarter as they intersect with artificial intelligence, which draws upon huge amount of data to fine-tune authentication. These tools have helped banks to improve customer service by allowing customers to open accounts remotely. For the middle office, banks can implement AI-based functions to detect and prevent payment frauds and to improve processes for anti-money laundering and know your customer. Given the large number of transactions taking place through the financial system every day, the number of investigations coupled with the complexity of data and reliance on human intervention makes AML very difficult and expensive work for all the financial institutions. AI-empowered AML solutions can incorporate three key advancements in this respect. First, intelligent segmentation or optimization of the data sifting process to reduce false positive, which is a major drain on the time and energy of AML analyst in a bank. 2. An advanced alert system which auto-categorizes alert priorities. And 3. Advanced transaction monitoring which uses machine learning to spot suspicious anomalies. These sort of solutions are able to process a large number of data points rather than just the usual 20 or 30 transaction categories which are analyzed in a normal AML solution. And it could result in a massive drop in false positive alerts, as I just mentioned. Cyber frauds are becoming increasingly sophisticated, manipulating identity information through account takeovers, exploiting cloud servers, IP addresses, etc. AI here can also help the banks to counter these by using machine learning on big data and related algorithms in real time. To benefit from AI, banks need a holistic AI strategy that extends across banks' business lines, usable data, partnership with external partners, and well-qualified employees. As opportunities are accompanied by risk, too much reliance on these intelligent systems also exposes financial stability to certain risks. The working of AI can be a mystery for a majority of people in an organization, and resultant lack of adequate and qualified supervision can trigger loss of control, make fatal errors, and have a pro-cyclical effect due to its mechanistic functions. This can be dangerous, particularly in crisis scenarios. An autopilot would not be able to handle the aircraft in emergencies, at least as of now. Nor can algorithms stabilize in period of financial stress. Agile tech companies are driven by an admirable energy and inspiration. By nature, their willingness to take risks is very high. They create an idea, build a prototype, and will like to try out immediately in the real world. Regulatory and supervisory requirements may seem to them unnecessary and may make them extremely uncomfortable. The regulatory bodies understand that there is a need to strike a balance. While we suitably address key concerns like cybersecurity, data privacy, consumer protection, and financial stability, we also don't want to let go key benefits of agility and innovation that are hallmark of tech companies. IT governance and information security nowadays are equally as important as capital and liquidity requirements. This thus requires regulators to constantly review and reassess the prevalent legal and regulatory frameworks, supervisory models, and resources to achieve this balance. In this respect, the State Bank has unveiled a national payment system strategy. This strategy focuses on improving the payment infrastructure, legal and regulatory framework, retail and remittances market, and government payments. The prime objective is to foster growth of digital payments and infrastructure in the country. In this regard, major action items include establishing an automated clearinghouse, micropayment gateway, and digitizing government payments. The establishment of automated clearinghouse and micropayment gateway would enhance number of times the infrastructure capacity to process transactions, and digitization of G2P payments, that is government to persons payments, would substantially increase the level of digitization in the country. We are also confident that once G2P payments are digitized, it will pave the way for digitization of P2P, P2B and B2P payments. State Bank of Pakistan would not, in general, like to interfere with market forces. However, at times, we may try to fine-tune incentive structure in a way as to meet our regulatory objectives. The growth in number of POS machines, point of sale machines, in Pakistan has for a very long time very low as compared to growth in the number of cards, and one of the major reasons was that acquiring business was not attractive enough as compared to issuing business. Resultantly, while we observed a decent growth in number of cards, the number of POS machines remained subdued. In order to improve the number of POS machines and QR touch points and incentivize the acquiring business, in January this year, we issued instructions related to fee structure regarding the merchant discount rate, that is MDR. A floor on MDR has been placed with a cap on interchange reimbursement fee for debit cards. Resultantly, not only the footprint of touch point has improved, but also new institutions have shown their interest in becoming acquirers. In order to further improve digital payment infrastructure, rules for digital onboarding have also been issued by State Bank, which have enabled the institutions to digitally acquire the merchants without physical interaction. Last year, that is in 2019, with the objective to promote digital payments, foster innovation in payment industry, increase financial inclusion in the country, and most importantly, and I will like to underline it, to enable non-banking entities to play a meaningful role in payment landscape, State Bank introduced a new license category of electronic money institutions, commonly known as EMIs. This will enable small companies to register themselves as EMI and offer innovative and cost-effective, low-value digital payment instruments such as wallets, prepaid cards, and contactless payment instruments. So far, 6 companies have obtained in-principle approval from State Bank of Pakistan to conduct e-money business. And out of these 6 companies, 3 have already graduated to pilot stage. E-money has played a very critical role in digitizing different types of payments in various countries, and we are also observing a very promising start in Pakistan as well. In view of the progress and future plans, mega platforms are also eyeing Pakistan's market for entry. Further, some of the existing institutions in Pakistan are also working towards harnessing the capacity and capabilities to become mega platforms. Hence, we see a bright future for digital financial services in the country, with lot of opportunities that can be harnessed by deploying and investing in technological innovative solutions. In the end, I will again like to thank the Total Communications and organizers to arrange this wonderful conference, and wish all the participants fruitful and productive discussions. Thank you very much.